Welcome to this training on profit level indicators, PLI, and their pros and cons. This training is intended to help you consider why one PLI may be more appropriate than another, based on the facts and circumstances of the project you're working on. PLIs can be divided into two different families, rates of returns and margins. Rates of returns are a measure of profit divided by a measure of assets. Margins are a measure of profit relative to a flow of costs or sales. Rate of return PLIs can include return on assets, ROA, adjusted ROA, return on capital employed. Margin-based PLIs can include operating margin, net cost plus margin, the Berry ratio, gross profit divided by operating expenses, and other margins. With so many PLIs to choose from, what is a transfer pricing practitioner to do? Think about your own situation for a moment. How do you measure returns? As a well-paid transfer pricing professional, no doubt you will be making significant financial investments in the future. There are so many companies competing for your investment dollar, and what will drive your decision? You will likely invest your assets where you think you will get the best return for the level of risk. All companies compete for capital, so the return they earn on their assets is critical to their long-term success. From an economic perspective, this makes rates of return a great set of PLIs. They're more closely linked to whether the economic returns make sense, given a certain investment in assets. ROA considers the return to assets less cash and short-term investments. Adjusted ROA can refine our analysis for differences in our comparable companies and our tested parties' accounts payables. And consider your big box retailers who may collect on its receivable well before it has to pay its suppliers. For such a company, the return on their capital employed may be the most economically relevant metric, or PLI. Of course, rates of returns are not always the most appropriate PLIs. There may be measurement issues related to, for example, depreciation and goodwill. These can impact the comparables and our tested parties' asset stocks. Our client may not have asset data to use in our analysis. Also, we need to be careful in terms of the industry we are analyzing. For example, retailers may see large seasonal swings in their operating asset levels. A final thought on rate of return PLIs. Don't assume that they are only applicable to certain industries or functions such as manufacturing. We may sometimes think of such PLIs as appropriate primarily for asset-intensive manufacturers. However, remember that most of a distributor's assets, receivables, and inventory are current in their value, and that these companies also compete for capital based on the rate of return they can provide relative to their risks. Margin PLIs offer another great way to determine whether a tested party's profits appear to be indicative of arm's-length pricing. Margin PLIs are more acceptable to tax authorities in certain jurisdictions. They can pose fewer measurement issues. They can be more consistent with how the client sets and maintains its transfer pricing policies. Of course, margin-based PLIs are not without their drawbacks. They are less linked to the economic returns. Put differently, a company or tested party could earn a high margin, but an uneconomic return on asset requirements. You may also find that your tested party earns returns consistent with comparable companies based on one profit-based PLI, but not another. You will want to then investigate the underlying economics driving these differences to understand why this is the case. Finally, look at all of the PLIs for your comparable set and tested party to see how they are similar or different. As is the case when selecting the best method for a transfer pricing analysis, selecting the most appropriate PLI when applying the comparable profits method or the transactional net margin method won't always be easy. In the end, you may feel like you are selecting the least worst PLI rather than the best one. But then, That's why transfer pricing is as much an art as it is a science.